Right. Good morning, everyone. Welcome to today's session on FRS 116 leases. So the way we planned your session is that there will be an accounting discussion on the accounting impacts as well as on the tax. So maybe for the first half we'll go through the accounting for lessees because that's the area which is most significantly impacted. The standard doesn't really change for the lessors, so we will not be covering that in today's session. One area where there are changes, but it's not a common transaction in sale and leaseback, which again we will not cover in this session. So we're going to be focusing primarily on the lessee accounting, and the second half of the session would focus on the tax impact because there are differences in the way tax views leases compared to accounting. So with that, I'll probably start off. Right. So in terms of what this new standard does, the biggest change, as I said, is for the lessees. And what it has done is it has eliminated the option of operating leases for the lessees. So in what is in scope of this asset, it's all leases and all subleases. What's not in scope are leases to explore mineral oil, gas, etc., biological assets, intellectual property, licensing arrangements, service concession arrangements, primarily because there is specific guidance in SFRS to cover these transactions. So the old standard for leases under SFRS was FRS 17, and there were a bunch of interpretations that were issued over a period of time. All that has been superseded by the new standard 116. As I said, now from now on, lease for the lessee. So when you take a building on lease, or an office on lease, or a printer on lease, or a car on lease, you're not required to do an assessment between finance and operating. The standard assumes all leases to be financing transactions, so you need to have a liability for your lease obligations. So what this means is that on your balance sheet you will have a lease liability, and come to the calculation part of it in a short while. But broadly speaking, when you enter into a lease, you will have a debit, which is called a right of use asset, and a credit, which will be a lease liability. In your P&L, you will depreciate the right of use asset. Generally, companies do that on a straight line basis. The interest on the lease liability will be calculated using the effective interest rate method. It's basically a calculation that was done for finance leases under the old standard. Now that becomes the default under the new accounting standard. So that's a big change because your balance sheet will gross up, your assets will increase, your liabilities will increase. Now, what this may have an effect is that some of your covenants with banks may get impacted, especially if your covenants have things like current ratios, EBITDA margins, or gearing ratios. So if you're getting impacted by the standard, you may probably need to go back to the bank, explain them the impact, and maybe even renegotiate your covenants. So the first thing that we're going to discuss is how do you identify a lease. The definition has changed slightly, but we'll still go through it because, as I said earlier, in the earlier old standard, the identification of lease was split over two guidances, FRS 17 and interpretation FRS 104. That all has been replaced, and you have one combined definition of lease. So the standard defines a lease as a contract or a part of contract that conveys the right to use an asset for a period of time in exchange of consideration. Important thing to note over here is that the standard doesn't say it has to be a lease contract. It can be any contract or part of contract. So in most of the cases, it won't be so complex. It would be a straightforward lease like an office lease, building lease. But some scenarios, you may have a contract for sale or purchase of goods, which has an embedded lease component to it because it provides you a right to use an asset. How do we determine that is what we're going to discuss now. Most common contracts which would fall in this category would be on a power purchase contract if you're in the power sector, or even more common would be contract manufacturing. So a lot of companies in Singapore have contract manufacturing arrangements with companies in Thailand, Malaysia, Indonesia, China. Now, those contracts will have to be assessed whether it contains an element of lease under the new standard. So the first question is there an identified lease? Is there an identified asset? When you say identified asset, it can be either explicit or implicit. Explicit would mean that the agreement specifies the asset. So for instance, if it's a contract manufacturing arrangement, the contract would specify the location, the factory, the plant, or the production line that needs to be used. But if it's not mentioned, then we really need to look at whether that contract manufacturer is only working for us. So while the contract may not say that you have to deliver it from your facility at a certain location, but because that is the facility, that is the only facility they have, or that is the only facility they have which makes economic sense. So let's say you enter into a contract manufacturing with a client who's supplying you products from Malaysia, but they also have facility in China, they also have facilities in India. Now, theoretically, it's not an explicit asset, but economically, does it make sense for them to supply you products from, say, China or India? They may do it on one-off basis if the production is down, but they can't probably do it on a long-term basis. So, in my example, then the facility in Malaysia would probably be an implicitly identified asset, because the other party will not be able to fulfill its obligations under the contract in an economically feasible way by using its alternative assets. So this obviously is an area which requires judgment and would require management to really look at it more holistically. Now, if there's no identified asset, because the company with whom you've engaged can easily supply you products from various locations that they have, and they can do it without any significant cost, then it's not a lease. The contract does not contain a lease, and it's a simple sale and purchase contract. But if it has an identified asset, then you would need to look at, does the customer have the right to obtain substantially all economic benefits throughout the tenure of the contract? So what this really means is, can you as owner benefit from that asset? When you're evaluating this, if you need to take into account whether it's an exclusive use. If it's an exclusive use of an asset, so all the output produced is purchased by you, then you are obtaining all the significant economic benefits, because nobody else can use that asset for anything else. The standard doesn't define what substantial means. So again, there's a little bit of judgment involved. Generally, we kind of take a 75% rule. So if more than 75% output from an asset is being purchased by one entity, that's a strong indicator that all the economic benefits are being consumed by a single customer. Then the third element would be, does the customer have a right to direct the use of the identified asset? Now, what does this mean? It basically means whether the customer or the lessee can decide when to use the asset, how to use the asset, for what purpose to use the asset. Again, in a simple office lease, all these criteria are automatically met, because the customer has the possession. They can decide when to open, when to close, or what purposes to use. Obviously, if there are restrictions, they will use that premises within the restrictions, but those restrictions will only be considered as a protective right. That does not mean landlord has a right to control the asset during the period of the lease. So for instance, you have an office lease which says you can't use it for residential purposes. So as long as it's an office purpose, you can run different types of businesses as long as it's an office. But you still have the control. Where it gets complicated is in scenarios like contract manufacturing, which I mentioned. So that's where it will become a little complex, because we'll need to really see to what extent and how do you control it. Now again, if it's a simple example is exclusivity, if it's an exclusive contract where I only use the asset, then yes, maybe we will meet all these criteria, because it's for me. Then I decide what type of production should happen, how many products to be produced, for what purpose they're to be produced, so on and so forth. So I guess the simpler the contract is, the easier it is to apply this definition. The more complex arrangements where you don't have a legal lease but an embedded lease, as we popularly call it, that's where you probably require a more judgment. As I said, if all these criteria are met, this is a lease. Now, please note that a contract, a part of which contains a lease. So, for example, a contract manufacturing, it essentially has two elements. If it meets these criteria, it will have a lease element and it will have a sale or purchase element. So you would need to segregate the two, the lease and the non-lease component, and apply 116 only on the leasing component. Also, this assessment is performed only on lease assessment. Once you have decided whether it's a lease or not, you generally do not change it. The only exception to that rule would be that when you have renegotiated your contract. So if you have a change in the contract, it's only then you will revisit and determine whether it's a lease or not. So once you've decided once you've done your assessment and you've come to a conclusion that it's lease, you would need to put the leased assets onto the balance sheet and the lease liability in the balance sheet. There are, however, two general exceptions or exemptions to this, and these are optional. You need not take it, but in our experience, most companies do avail these exemptions. So the first one is for short-term leases. So the short-term lease means leases which have a lease term of less than 12 months. Now, if your lease has renewal options, please consider the probability of exercise of those renewal options, because the lease term has to be based on has to be determined taking into consideration the probability of exercise of renewal options and termination options. So if you have, say, a lease for 1 year which has another 2 renewal options of 1 year each, then, and if the management considers that they will renew the lease at least for 1 year, because they've when they took over the lease, they made renovations, and it doesn't make sense to vacate it in 1 year, then your lease term will be 2 years. It won't be 1 year, and in that case, you will not be able to apply the short-term lease exemption. A couple of other points to note: election is made by an underlying class of asset. So when you put your ROU asset on your balance sheet, it will go to the respective class of assets in the PP: building, property, equipment, cars, etc. So it has to be made. This election has to be made for an underlying class of assets. As I said, the determination of short term depends on the lease term. Lease terms that contain a purchase option are not considered short term. So if you have a lease which gives you an option to buy it at the end of the lease term, you can't apply this, because you have effectively transferred risk of reward of ownership of that asset to you. Any modification in leases, so say if you consider something as a short term on day one, and after 1 year you again revisit and say, okay, no, I initially thought I will only hold this lease for 1 year, but now I want to extend it. So this doesn't mean you have made an error and you need to go back and change that error. You will treat it as a lease modification after 1 year and do the assessment again, whether the lease term should be 1 year or more than 1 year, depending upon the contractual obligation. And obviously, the last element is the disclosure. Such short-term lease expenses are separately disclosed in your financial statements when you prepare your annual financials. The second exemption is low-value assets. Again, this is based on a lease-by-lease basis. So while short-term lease was on an underlying asset class, this is on a lease-by-lease basis. The standard doesn't define what low-value asset is. However, IFRS, which is the IFRS 16, which is the equivalent of IFRS 116, in its basis of conclusion has $5,000 as kind of a suggested benchmark. It's not in the standard, it's just a suggestion by the standard setters. So that's something you may want to consider when you're evaluating what a low value asset is. But again, $5,000, you should not use it as a bright line, because for some companies it may be okay, but some of the smaller companies it may not meet the materiality thresholds. So whatever decisions you take, please do consult with your auditors if they're comfortable with that. Excuse me. So the assessment is based on the value of asset when new. So how do you determine the low value asset? What is the value that you should be using? So if you enter into a lease, you need to figure out what would have been the value of the asset if I buy it today. So let's say you take laptops on lease. You take 1,000 laptops on lease, and you determine 5,000 Sing dollars is your threshold for low value asset. Now, if you were to go out and buy that laptop, it would have costed you probably $2,000. So you can then apply this exemption to all the 1,000 laptops you've taken on lease. Even though the gross amount is much higher than 5,000, but you can apply it independently to each asset. However, as the next point indicates, if there is interdependence between assets, then you can't apply this. So let's say if that laptop is to be used in conjunction with a high-end server, and the server costs $50,000, and both are interdependent, that the laptop cannot work with the server, then you can't apply this, because then you have a mother asset which comprises of two components, a laptop and a server, and maybe something else, and this exemption is not available. And the last point is head leases. So if you are in a essentially a sublease position, then then this exemption will not apply to a head lease. So if you take an asset on lease and sublease it forward to maybe say a related party or someone else, then this exemption is not available to you. What is the impact of availing this exemptions? The impact is that you don't need to put your leases on the balance sheet. You just recognize expense in the P&L as you were doing it under the old standard. So now the next question is, once we have decided it's a lease, we need to put something on a balance sheet. How do we determine that? So we're going to cover lease liability. So lease liability is sum total of fixed payments, which is the minimum lease payments that you have contractually obliged to pay, less any incentives received or receivable over the lease term. So for example, many times when you enter into a contract, the landlord may give you an incentive to relocate and maybe do renovations. So those are the incentives that you may consider adjusting against your fixed lease payments. The second element is the variable payments based on index. Now, please note that only variable payments which are based on an index are included in the calculation of lease liability. We all know that in the real world, variability can arise due to many factors, and the most common one, especially if I take example of retail, is the variability comes from the sales. So typically a retail lease contract would have a base fee, which is the fixed payment, plus a variable component, which would say, let's say 10% of your sales in a month. Now that is not based on an index or a rate. So this will not be used in calculation of your lease liability. Any variable component in such a lease that you pay will be recognized as an expense and that incurred. In payments based on an index, the most common ones would be payments which are readjusted based on a consumer price index or an inflation index or a market index. In such cases, when you recognize your lease, you will take the latest available data with you as the base case data. And next year, let's say you start with a base of say 100. Next year, the consumer price index increases from 100 to 120. You will recalculate your lease liability based on the new payouts, and you will continue to do this recalculation every year when the index changes, which causes the change in your variable payments. So it's important to note, the difference between variable payments based on an index versus other variable payments. It's only the index ones which are considered for calculation of lease liability. Then any expected payment under residual guarantee, where you have given a guarantee on the residual value, you need to include that. Any purchase option and any termination cost that you may have to incur. The sum total of this will become a lease liability in your financial statements. Once you've determined that, you now need to calculate the ROU asset. So ROU asset is the initial amount of lease liability. So the starting point for ROU is the liability that you've calculated, plus any prepaid lease payments, because a lot of time what happens, you have to pay an advance rent. So you add that to, which will not get captured in your liability, because liability is the present value of future minimum lease payments, less any lease incentives received, plus initial direct cost. Initial direct cost would mean cost that you incur to enter into a lease. This would include stamp duty, broker fees, any legal costs, etc. It should be directly attributable, the costs that have been triggered by signing up for this particular lease, plus estimated cost to remove or dismantle. So basically this is an asset restoration obligation, which means when you return the asset, you will return in its original state. This is a very common feature in most of the office leases. So you should be providing for it. The entry would be that your future expected cost you will determine. If it's more than 1 year, you will discount it. Your entry would be, it could either be a leasehold improvement debit to provision for dismantling, or it can be ROU asset plus debit to provision for dismantling. But you need to do it in accordance with FRS 37. Important point to note is that a lot of this is not a new requirement. This has been there under the old standard through FRS 37. So if you have not done it in your previous leases, there might be an error in your last year accounts. And again, if that is material, you should probably discuss it with your auditors on how to present it in the financial statements. The next is subsequent measurement. So essentially, the subsequent measurement would include the calculation of the lease interest. So you have the initial value, you will accrue interest. Now, what is the interest rate that we use? Now, what the standard says is that you use the implicit rate of interest in the lease. However, in the real world, you will probably not get that from your landlord or your lessor. So the next best alternative would be an incremental borrowing rate. If you have borrowings, that's fairly easy for you to calculate as to what your incremental borrowing rate would be for a borrowing with a similar tenure and for a similar asset. So you need to match the tenure and the asset type. If you don't have borrowings, then you can get indicative rates from your banks. I mean, we've seen many clients reach out to their banks. They do get an indicative rate, which might be your best estimate for calculating the lease liability. And the last would be remeasurements. Now, these remeasurements generally would happen on account of two reasons. First would be the index variable payments based on index, and the second one would be if there's a lease modification. So anytime your lease is modified, the tenure changes, the cash flow changes, you will have to recompute your lease liability, and the corresponding adjustment generally goes to the ROU asset. The only exception to that rule is when you're terminating your lease or you're reducing the scope of the lease, then you will have a P&L impact. Excuse me. For ROU asset, once you've determined ROU asset, you decide the depreciation policy under FRS 16. So in that scenario, you select either the cost model or the fair value model. For the cost model, you depreciate it over the life and test it for impairment if there's an indicator. If it's a fair value model, then you would fair value at every reporting date, and the fair value gains and losses will go into the P&L. So in terms of presentation in the financial statements, the presentation on the balance sheet, it can be a separate line item, or you can combine it with the respective PPE, or if it's an asset which you have taken on lease for further leasing out, it may become an investment property. So you may want to show it as an investment property in the financial statement. Lease liabilities, you show it separately or you combine it with the other liabilities. In either case, there will be additional disclosures. So even if you combine the PPE with other assets and lease liabilities with other liabilities, there are more disclosures that are required by 116 to kind of give the users an understanding of what the lease assets are, what is the book value, gross book value, depreciation, and the net book value. And similarly for lease liabilities, you'll have to present in notes the current, non-current portion and the maturity profile. So essentially, you'll need to give a table which will present how much of the lease obligations are payable in, say, 1 year, 2 year, 3 years, so on and so forth. In the P&L, interest expense goes as part of finance cost. The depreciation essentially goes, it goes separately as part of your depreciation. Now, if you present by function where you have a gross profit, the amortization or the depreciation may have to be split depending upon what asset is used for the production and what asset is used for admin purposes. Interest and depreciation are not combined. They're not allowed to be combined because they're separate. So if you see, the impact on the P&L would be that you'll have a slight improvement in your EBITDA margin, because under the old standard, rental expense was a deduction from your EBITDA, but these two items are not. In the cash flow statement, like the P&L, you'll have to split. The interest will go to, so rental was always part of operating activities, but the amount of rent that you pay every year, every month will have two components. It's an interest component and a capital repayment component. So to the extent it relates to lease liabilities, that is financing activities, to the extent it's for interest, it can either be an operating or a financing depending upon how you've done it in the past. Low value short-term leases, you still consider them to be part of your operating activities. So as you can see, all the three primary statements out of the four primary statements will have some level of impact on the way you present your financial statements. Now, this next element is for a specific exemption that has come in because of the COVID-19. So as I said earlier, generally when you change the cash flows or the tenure, it leads to a modification, which means you recalculate your liability, and the difference between the old liability and the new liability is an adjustment to your ROU asset. But because of the COVID-19 pandemic, there are a lot of rent concessions being given by pretty much everyone. When I say everyone, pretty much every government across the globe. So based on this, ISB has come out with an amendment which allows lessees to not to account for these rent concessions as a lease modification if they result from COVID-19. And there are certain conditions that have to be met, namely the revised consideration is substantially less or same or less than the original consideration. So which means that, if the lessor waives your rent for say 3 months, then the overall consideration in the contract has gone down. But if he waives it for 3 months and then increases the rent over the subsequent period, then it still remains the same, because you still have to pay him the same amount. It's just that the payment pattern has changed. But if he does a calculation where he waives for 3 months today, but because of the loss of interest, he increases the future rentals by more than what he's losing today. So he factors the future interest, or he backloads the entire thing, which results in the overall consideration becoming higher than the original one. Then you can't apply this exemption. You still have to apply lease modification. The second condition is the rent concession is for payments which were originally due on or before 30th June 2021. So any leases where you have concessions from landlords for payments due on or before 21, you can apply this. Any payments after that, any concessions for payments after this cutoff date, you can't apply this guidance. And there are no other substantial changes made to the lease terms. So essentially, the tenure, the type of asset, other elements do not change. The effect of this is that any rent concessions that you have, you don't need to modify. Your original lease calculations continue as it is. And you just recognize that concession as a gain or loss in your P&L today. The reason for this is that, for some companies which have large volumes of leasing, especially say aviation, retail, it might be really onerous for them to kind of do the modification accounting. So it's like a shortcut accounting that has been offered by ISB only for concessions that are given up to a certain point in future. But it's a very, very limited and a narrow scope amendment to FRS 116. Technically, it hasn't been adopted in within 116 as of now, because this amendment by ISB just came out towards the end of May. But we expect similar amendments to be adopted in Singapore pretty much at the same time. I think that was mainly on the lessee accounting for lessee, as to how you need to account for it and how you need to present for it. The last section on the accounting side would be the transition requirements. How do you transition your existing leases into the new standard when you move to 116? So the cutoff date is 1st Jan 19. This is the date when the standard becomes effective. Now, you have two options over here. Either so you could have applied it last year, but obviously that's not relevant right now. So if you've not applied it in January 2018 along with 116, you have two options. What those options mean, it basically is called a full retrospective or a modified retrospective. So the cumulative catch-up on your screen refers to the modified retrospective. So the first step would be to identify all leases that you have, all lease contracts that you have. assess whether they meet the definition of the lease. Now, as I said, the way you should approach it is you identify all contracts which have a fixed payment every month or quarter or year and see whether it meets the definition of a lease. Because in a normal sale purchase of goods or services, a fixed commitment per month would generally not be there. So that's probably a good starting point. If you had assessed a certain contract not to be a lease under the old standard, you can apply the grandfathering provisions under the standard and still consider them as not as leases. So what this means is that you determined under the old definition of lease under this old standard that a certain contract manufacturing arrangement is not a lease. You can apply an exemption available in the standard and continue to not treat it as lease. But any new contract you enter into after 1st Jan 19, you will not have that option. It's only a one-time relaxation. Once you've identified your overall population, then you determine which approach. Full retrospective would mean going back and recalculating everything from the transaction date, meaning the date on which you entered into the lease. This also means that for 1st January 19, your comparative period will have to be restated. So you will present 3 balance sheets. So for a December 19 year end, you will have a 31st December 19 balance sheet, 31st December 18 balance sheet, and 1st Jan 18 balance sheet. You should go for this approach only if you have a significant leasing impact and you want to really present, and it's distorting your 2019 balance sheet. Because if you go for this approach, you will have to recalculate everything from the transaction date. So say if you have taken a 20-year-old lease, you'll have to go back in time 20 years, determine a discount rate applicable at that date, and then redo your calculations till 1st Jan 18 and post adjustments in your books. So not a very easy way of adopting the standard. And given our experience, most of the companies don't do it. Very few companies have taken this approach. Most of the companies generally go in for the modified retrospective approach. So what the key difference is in a modified retrospective approach, you don't have to go back in time. You say 1st Jan 19 is my cutoff date. I will determine my lease liability as the present value of minimum lease payment due after 1st January 19. So it reduces a lot of work for you. On day one, then you can opt to elect your ROU asset as equal to your lease liability. The reason I say opt is because if you remember the definition of the calculation of ROU asset is lease liability plus or minus certain things. But the standard gives you a practical way out by saying that on the date of transition, you can say it is equal to the lease liability because you may not have information on lease incentives received in the past, or you may not have information about an initial direct costs that were incurred because you've expensed everything, and it may be really onerous to to figure that out. So you can do that, and life really moves on. A couple of more practical expedients given under the standard. So you can apply a portfolio discount rate. What this really means is that if you have large number of leases, you can create portfolio of leases based on tenure and nature of assets. So if it's of a same category of assets, let's say cars, you've taken a lot of cars on lease, and you can then bundle them together and say this is one portfolio, and you can provided their lease tenure is similar. So maybe 3-year lease could become one portfolio, 5-year lease could become another portfolio. Now in such a scenario, instead of calculating lease liability for each individual asset, you can do it for the entire portfolio. So if you have say 500 cars, out of which 100 are 1-year lease, 200 are 3-year lease, and the remaining 200 are 5-year lease, you can create 3 portfolios and do 3 calculations instead of 500 calculations. Use of hindsight is another practical expedient. This is particularly relevant for renewal options. So on 1st January 19, you have a lease which is due to expire in say August, and you have a renewal option in this. Now sitting in June 2020, when you're doing your accounts, you know that you have already taken that renewal option and the lease is renewed. The standard allows you to take the benefit of this hindsight and take a longer lease term if you want to, so that you can reduce the burden of calculation on your finance team. So otherwise you would have to first do an initial assessment on 1st Jan 19 and then do a calculation on August 19, and none of these practical expedients will be available. So you will then have to do a fresh calculation. So a use of hindsight is allowed. For ROU asset, as I said earlier, the first practical expedient is ROU asset is equal to lease liability. The second one is onerous leases. So where you have an onerous lease, the standard allows you to adjust it on day one so that you don't have a P&L impact. In a normal scenario where you have an onerous lease, which means the cost that you pay on the lease versus the benefit you derive out of it is more, you have to recognize a loss. So you can potentially park all your losses on day one if you use this exemption in the balance sheet. And the third is obviously initial direct cost. If you take the ROU asset is equal to lease liability, you don't need to worry about the initial direct cost that might have been incurred in the past, and you have no way of figuring out what those mean. So a couple of things to consider when you're transitioning to FRS 116 on 1st January 19. With this, we'll move on to the tax element. My colleague Emily would take up the tax part for 116.
Okay, hi guys. Thank you, Chetan, for the accounting aspect of FRS 116. So now I'll go on to touch on the tax aspects of 116. So as you know, in recent years we have had various accounting standard changes like 105 and 109. So for most of these accounting changes, what has happened is that tax typically attempts to align the accounting adjustments to the tax treatment such that there's minimal work to be done on the taxpayer side. So unfortunately for 116, I would say tax remains pretty much quite independent of the accounting standards. So tax, we have our own set of rules to determine the tax treatment. So as a result, I think for lessee accounting, where 116 impacts the most, there will be quite a fair bit of tax adjustments to be considered. For lessor, I think because 116 doesn't really impact the lessor accounting, so in terms of tax treatment, it will remain largely unchanged. Okay, so in terms of the tax treatment, we actually draw guidance from 3 areas. One of it will be Section 10D of the Income Tax Act, which governs the income from operating and finance leases of plant and machinery. The next part will be Section 10D regulations. This is the subsidiary legislation of Section 10D, and also a recent RAS circular issued on 8 October 2018 in relation to the tax impact of FRS 116. Okay, so the next slide here actually depicts the tax classification of a lease under our Tax Act as well as the regulations. So for tax purposes, when you first get a lease agreement, I think the first question we need to ask is whether it's a finance lease, and the definition is provided under Section 10D, subsection 3 of the Income Tax Act. I'll give you the definition in the next slide later. So if it is if it's not a finance lease, then very clearly the lease is an operating lease. So meaning the lessee actually is incurring rental expense and the lessor has the ownership of the asset. If the lease is actually a finance lease for tax purposes, you will see later on in the next slide's definition, finance lease is very broad. So that in itself is not good enough to determine the tax treatment. So we have to go through a series of conditions and questions to ask under regulations 4.1 of 10D. So this is the regulations we're talking about. To determine whether the finance lease arrangement in this case is a finance lease treated as a sale agreement, effectively whether the asset has been sold to the lessee or whether it is not. So if it is, then it's one set of tax treatment. If it's not treated as a sale, then the tax treatment is essentially similar to an operating lease. So broadly for tax purposes, I think there's 2 different tax treatment. One is operating lease and one is a finance lease treated as a sale agreement. Okay. So now I'll give you the definition of what a finance lease is under the Tax Act. So finance lease, and this definition I think has its background in FRS 17, which defines a finance lease to be a lease of plant or machinery which has the effect of transferring substantially the obsolescence, risks, or rewards incidental to the ownership of such plant or machinery to the lessee. So as you can see, this definition is very broad. So so in order to determine the tax treatment, we have to ask whether this finance lease in itself effectively gives rise to a transfer of ownership to the lessee. So we will go into the definition of finance lease treated as sale. So finance lease treated as sale, that's actually under Regulations 4.1 of Section 10D. And all of these 5 conditions here, you will note, it effectively indicates a transfer of ownership to the lessee. So number 1, where the lessee has the option to purchase the lease upon the expiry of the lease agreement. Number 2, where it's a limited use asset. So if the plant or machinery, you cannot envisage that any other person would be able to use the asset at the end of the lease, then quite clearly, I think the lessee effectively owns it, And the third condition, where it's in a sale and leaseback arrangement. So this is, I guess, quite common, where the lessee is in need of cash flow. They choose to sell the equipment, but lease it back from the lessor. So effectively, the lessee owns the asset as well. And then the fourth one will be additional conditions for related party transactions. This is actually defined in the regulations, and essentially, for this condition, it means that there arrangements where the lessee effectively provides funding to the arrangement such that, in essence, the asset is actually owned by the lessee. And the last one is leverage lease. So leverage asset will be a situation where there's a third party financing the arrangement such that, and there is no recourse to the lessor, even if, the loan is not being paid up. So effectively, the lessor doesn't own the asset, and it's actually the lessee that owns the asset. So if any of these conditions are met, then the lease will be treated as a sale, and it will be a different set of treatment as compared to an operating lease or a finance lease not treated as a sale. Okay, so with that, I'll go on to discuss the corporate tax treatment for. Sorry, one sec. Hang on, I'm just trying to go back to the earlier slide. Okay, so in terms of lessor accounting, the tax treatment for lessor, in the case where it's an operating lease, effectively the lessor is earning rental income, and it still owns the asset. So what will happen is that the lessor will be taxed on the contractual lease income, meaning what is a rental income that is earning on a month-to-month or a year-to-year basis based on the contract. Okay, and then if that lease, the asset in question qualifies as a plant or machinery for tax purposes, then potentially the lessor can claim capital allowance on that asset. Okay, and then for finance lease treated as a sale arrangement, if the answer is no, the finance lease is not treated as a sale arrangement, meaning none of the 5 conditions I mentioned earlier slide are met, then effectively it is still an operating lease, meaning the lessor in this instance still owns the asset. So the tax treatment will be exactly the same as what is in the earlier box, which is the lessor will be taxed on the contractual lease income, the rental income per the contract, and it can claim capital allowance if that asset in question is a plant or machinery. Okay, but one thing to note is that under Section 10D of the Income Tax Act, it is quite clear that capital allowance can only be used to offset the rental income from the lease. So if you have any other sources of income, you cannot use that capital allowance to offset against the income from the finance lease unless you have ceased your finance leasing activities. Okay, so that's a specific provision in Section 10D. However, if the finance lease is treated as a sale arrangement, meaning effectively the lessor has already sold off an asset, and it's really just a financer providing financing to the lessee, then the lessor will be taxed on the interest income implicit in the lease agreement, and clearly because it doesn't own the asset, it will not be allowed to claim capital allowance regardless of whether the lease in question relates to a plant or machinery or not. All right, so that's for the tax treatment for lessor. For lessee accounting, just to reiterate, FRS 116 affects mainly lessee accounting. So here there will be a couple of tax adjustments that you now have to put through compared to prior to FRS 116. So in the case of an operating lease, the lessee effectively is just renting an asset. Okay, so what the lessee can claim here, provided the asset, of course, is employed in the trade or business, you can claim a tax deduction on your contractual lease payment. So the amount that you pick out in your lease agreement, and you will not be allowed a capital allowance claim, primarily because you do not own the asset. And then the thing is, because for FRS 116, there will be interest expense that's being charged to the P&L as a result of computing the present value of your future lease payments, and there will be depreciation expense as a result of unwinding your right of use asset. So these two items are to be added back in your tax computation. All right. Yeah. So then, when it comes to finance lease treated as a sale, meaning the lessee in this case has acquired a capital asset. So it is also getting financing from the lessor, right? So you will be able to claim interest expense that is flushed through the P&L as part of the financing cost, and also capital allowance on the asset if the item qualifies as a plant and machinery for tax purposes. And the depreciation, accounting depreciation expense, clearly you cannot claim a deduction, so you would have to add that back. And then next, for finance lease not treated as a sale, as I've highlighted in the earlier slides, that is similar to an operating lease. That is, in essence, an operating lease. So what the tax treatment for the lessee would effectively be claiming a tax deduction on the contractual lease payment. So what is your rental expense in the lease agreement? And any interest and depreciation that is being charged to your profit and loss statement would have to be added back. And likewise, like an operating lease, the lessee does not effectively own the asset, you will not be allowed any capital allowance claim on that asset. Right. So then, having covered the corporate tax aspect of this, the question is, if I'm making rental payments to my non-resident lessor, clearly the question is, would withholding tax apply? And if so, what is the nature of the withholding tax and what is the rate? Okay, so tax, as I've mentioned, is quite independent of accounting for FRS 116. So any withholding tax implications would be based clearly on the legal characterization of the payments. In other words, the accounting entries that is passed, be it depreciation expense, interest, you have to look at the underlying tax principles, as I've explained in the earlier slides, to determine the withholding tax implications. So generally, I would say for most payments made to the non-resident lessor, the lessee would have to withhold taxes. I guess the question here is more of, what is the nature of payment for which withholding tax applies? So in a case where finance lease is treated as a sale agreement, meaning the lessee has effectively acquired a capital asset, then the purchase of the capital asset is not subject to withholding tax, but the portion of the interest element that is implicit in your lease agreement would have to be subject to withholding tax. So to withhold taxes based on that interest that is charged to the P&L. So here in the RIA circular, they went on to describe the various types of interest expense that withholding tax should apply. So I think in summary, it is saying that generally, if you can get the interest payable implicit in the lease agreement, then you should withhold tax based on that. If you can't, then you should be withholding based on the lessee's own incremental borrowing rate, which is what Chetan has explained earlier. So, not to worry. I think all of this sounds very complicated, but I think in essence, you're just withholding based on the interest expense that is charged to the profit and loss statement. And in most cases, it would be the lessee's incremental borrowing rate, because I don't think the lessor, in most instances, would let you know what is the interest cost involved in the arrangement. Okay, so that's for finance lease treated as sale. As for operating lease or finance lease not treated as sale, these two items, we lump it together effectively, the lessee is just renting an equipment from the lessor. So that in itself, you most of the time treat it as a rental expense and withhold taxes if it relates to rental of movable properties. But if in this case you are actually renting an office premise, so it's an immovable property, then withholding tax will not apply. Okay, so you will note here that withholding tax really depends on, in substance, what is the lessee really paying for. And then just one minor point to highlight on withholding tax is that I think under Section 13 of the Income Tax Act, there are some exemptions for chartering of ships. And we would just like to highlight that that only applies for an operating lease. So even if it is a finance lease that does not meet the definition of a sale agreement, you would the exemption will not apply, and you would have to withhold taxes as though it's a rental of movable properties. Okay. So with that, I'll go on to touch on other issues arising from this FRS 116. So with FRS 116 for the lessee, you will note that for most leases, you would actually recognize a right of use asset. So the question is, if I as a lessee have been computing interest restriction based on the total asset method, will the right of use asset affect my interest restriction calculations? So I think the answer is there. It's generally not affected. Reason being because in the case of a finance lease not treated as a sale, you can directly identify the source of funding, the interest cost to the acquisition of the asset. So clearly that is not subject to interest restriction, and correspondingly the asset is not will not be included in the total asset base. And whereas for operating lease as well as finance lease not treated as a sale, you effectively have claimed the interest expense as part of your contractual lease payments. So that in itself will be excluded. So in conclusion, your right of use asset will not be included in your asset base for interest restriction purposes. And then as for transitional tax adjustments, so this is good news, I guess, because 116, the implementation of 116 effectively did not have any impact on the tax treatment. So because of that, there will not be any transitional tax adjustments to speak of, because there's nothing to align to. You are kind of sticking to what you have been applying since day one. So there will not be any transitional tax adjustments arising from the implementation of 116. Okay, and I think so as with all new standards, the next question is, well, in the preparation of my tax computation, do I need to submit any documentation? Like for 109, you will need to submit your list of capital assets and things like that. So I think for 116, for the lessee, you would need to keep your tenancy agreements and your lease agreements, but you need not submit it to the tax authorities. However, what you do need to include in your tax computation is your reconciliation of your contractual lease payments to the expenses reflected in the profit and loss statement. Reason being because the amount that you're claiming for tax deduction, which is the contractual lease payment, would now not be reflected in the P&L. What will be reflected in the P&L is the depreciation expense on the right of use asset as well as the interest expense. So you need to provide the reconciliation to the RAS so that they can make sense out of your calculations. All right. So I think that's for documentation. And then just one last final bit on FRS 116 is, what about the GST aspect of it? Generally for rental services, right? We will treat it as a supply of service. So generally, I think for lease, it will be a supply of services. So you kind of account for GST as and when the services are rendered. However, there will be situations where you would have to account for GST as though it's a supply of goods. So that will be where upfront in the lease agreement, it expressly contemplates that ownership will pass sometime in the future. So I guess a very good example for this will be for hire purchase assets, where you account for GST as though it's a sale of goods upfront, and even though you may not have owned the asset until you effectively make all your payments. All right. So I think with that, I have covered the tax aspects of FRS 116, and I'm happy to take on any questions that you guys have.
If anyone has any questions, please feel free to just add them to the chat or unmute yourself and ask them to Emily or Chetan. I have one question for you, Emily. Will there be a deferred tax impact arising from the adoption of FRS 116?
Okay. Definitely there will be. There will be deferred tax impact even before implementation of 116, but with 116 it becomes there will be more, especially from the lessee's perspective, because what has happened is that there will be a difference between what is charged to the profit and loss statement as depreciation expense and interest versus what you actually claim as contractual lease payments. So because of that, it will give rise to a timing difference, and that will in itself give rise to a deferred tax impact.
Thank you. We haven't had any more questions in the chat. So unless anyone wants to unmute themselves now, I think we're ready to close the session. Yep, I think we're ready to close. Thank you everyone for joining, and we'll follow up with you to send you the recording as well. If you have any questions, please feel free to contact a member of our team. Thank you. Bye.